Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of the threshold filing requirements for U.S. taxpayers who are required to file Form 8938. Form 8938 is required in accordance with Internal Revenue Code Section 6038 Cap D. It's regarding specified foreign assets, for example, foreign bank accounts, other types of investment accounts, life insurance policies, pensions, things of that nature. It's similar and it overlaps with the FBAR, but it's different. It's filed directly with the IRS. It's filed with a 1040 or similar tax return if you're a U.S. person filing. But unlike a form like the FBAR, it has different threshold requirements, which means depending on who's filing the form, are they filing single, married filing separate or joint, and are they a U.S. resident or foreign resident, can impact what the threshold requirement is as to whether they have to file the form or not. In addition, did they live in the U.S. for the full year or part year? Did they file the 1040 NR in a dual status return type of situation? Did they just begin living in the United States and only met the substantial presence test after a certain amount of time? Let's walk through using examples, right? Examples are typically the best way to kind of figure something out, especially when it comes to international tax. So let's just jump into it. So a single person living in the U.S., okay? Taxpayer is single. She has $80,000 in foreign bank accounts. She would be required, and for all these examples, assume that they're a U.S. person for tax purposes, right? She would be required to file Form 8938. Why? Because the threshold requirements for being single living in the United States is more than $50,000 on the last day of the year or more than $75,000 on any other day of the year. Take taxpayers Joe and Jane, they're married, and they have $190,000 in foreign financial accounts. They too would be required to file Form 8938 because the threshold requirements for married filing joint, for married, assume they're filing joint, right? Married filing joint living in the U.S. is $100,000 on the last day of the year or $150,000 on the other day of the year. So even if it's below $100,000 on the last day of the year, but during the year it exceeded $150,000 on any day, then it's required as well. And it's total annual aggregate total to remember. So it's not just does each account have to have more than the value. It's whether the total value of all the accounts combined exceeds the threshold on any day of the year. Taxpayers living abroad, it's a little bit different. The thresholds go up significantly. So let's say Jane lives overseas and she has $180,000 in foreign financial accounts, and that's the most that was in the account on any day during the year. She would not have to file it. Why? Because if you're living overseas and you're single, the threshold is $200,000 on the last day of the year or $300,000 on any other day of the year. So if the taxpayer only has less than the $200,000, not only, right, but if they have less than $200,000, then they're not going to be required to file the form. And then taxpayers who are married living abroad, that doubles to $400,000 and $600,000. So let's say taxpayers are married and they have $500,000 on the last day of the year in foreign investment accounts and life insurance, then they're required to file the form as well. The threshold is more than $400,000 on the last day of the year or more than $600,000 on any other day of the year. So even though they didn't reach the $600,000 mark on the last day of the year, they had more than $400,000, right? They had $500,000. So they're required to file the form. Now, it gets a little bit more complicated when you're dealing with things like substantial presence. So let's take taxpayer moves to the United States in April. And so they met substantial presence, so they're filing taxes on their worldwide income. For purposes of 8938, they only have to start looking at it when they became a U.S. person, when they started. So that would be April when they first took residency in the United States. And then you've got the part-time resident issue. Maybe someone was a U.S. person, let's say it's their final year, and then in August or September they expatriated or they moved out of the U.S. And so they filed a 1040 up until the point where they were a U.S. person, and they filed a 1040 NR for the remainder. You only have to use the portion that you're a U.S. person. What the IRS is getting at is you only have to include the portion for 8938, the values for the portion of the time that you were considered a U.S. person for tax purposes. Even if you're filing a dual status return, it doesn't mean you have to include the time when you were not a U.S. person to determine whether the aggregate value is reached. A couple of other options to consider. If you are filing a joint tax return it's important to remember it's joint and several liabilities for the penalties. So even if it's one person who's filing one person with the foreign assets, the spouse can also be liable for penalties if it's penalized because it's joint and several. It's a joint return. So the way the IRS sees it is, well, it's the return that filed it late, or it's the return that didn't file the 8938. So combined, it could potentially be both spouses. And there's arguments and defenses and exceptions, exclusions, limitations, but that's the baseline. The other thing to consider is, a lot of times people who use commercial software like TurboTax, Tax Act, H&R Block, they'll file the 8938 because that's included with the software program. It's a form that's part of your U.S. tax return. But there may be several other forms that are required as well, and these forms are typically not included with the software. The FBAR, foreign bank and financial accounts, the 8621, which is to report foreign PFICs, which is typically going to be mutual funds and ETFs, but not only, also passive holding companies. 3520 and 3520A is for trusts and receipt of large foreign gifts, inheritances, and trust distributions. Trust ownership, as well as foreign trust distributions. 5471 for ownership of a foreign corporation, and 8865 for foreign partnership. For taxpayers who are out of compliance, there are various programs you can use to get into compliance. We got a ton of free information on the website that goes through this, but baseline is VDP if you're willful, streamlined domestic or streamlined foreign. They both fall under streamlined filing compliance procedures, reasonable cause or delinquency procedures if you're non-willful. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.